Hello again, ladies and gentlemen. Thank you for tuning in to Ascending Abundance YouTube channel. My name is Pavel Sverdlin, CFA, CPA. Hopefully those letters mean something to you. I'm not an advisor though, so please take this as my own personal take on things and not an advice or recommendation what you should do with your investments. Today I'm looking at pipelines, and I just posted an Enbridge video. This is a TransCanada Pipeline, or TC Energy as they call themselves these days. I've held both Enbridge and TC Energy for more than a decade. Collected those dividends. I was happy when dividends were increasing by 10-15% a year. Lately it's been barely 3%. The stock has not done that well. I'm comparing them both, and TC is kind of down just very recently. So far they've been, over the 10-year span, pretty much the same thing. Up and down, somebody is better. It seems like Enbridge is mostly better, but it all depends. What Enbridge is to oil, TC Energy is to natural gas. They have a huge portfolio of natural gas pipeline assets. All of it is regulated. Most of it is contracted, super safe, super stable. The challenge I've got with them is that the dividend at almost 8% dividend yield is looking kind of iffy and may not be sustainable. So I wanted to take a look as to what this company is about. Looking at them, if we compare to, let's say, S&P 500, which may or may not be comparable, you would immediately see that S&P beat them handedly. So those dividends, even though they're higher, are kind of costing us the opportunity that this could represent over the longer term. Now, is this a function of higher interest rates? Potentially. Are they being punished for having a lot of debt? Yes. Are they also being punished for having a dividend? Hefty dividend that is no longer as exciting to investors as they used to be. I think that's part of the story, or big part of the story. Dividend paying stocks are not as exciting because bonds are competing with them for yield, and when TC Energy or Enbridge paid 4-5% but inflation was 1%, that was kind of exciting. You're beating inflation. If inflation is 9 or 7 or even 6, and the dividend is still 4 or 5%, that's less exciting. So the price goes down, yield goes up. Now this yield is about 7.5%. Now the investors are kind of comfortable, but that has punished us, the shareholders, in terms of the price is not moving anywhere. And the more expensive debt means that these companies have less cash flow to distribute, so their dividends are not growing as high as they could be. So I looked, as usual, at the just investor relations part of their website, looked at reports and filings, kind of clicked in there, looked at dividends, presentations, pulled out their annual report right here, gone through page 142 or something, yes, and found their financials. This is the income statement. I like to change them into my own Excel. And I barely look at sort of the profit margin, make sure it's positive. Hopefully it's growing, but lately it's been down in 2022. But so far, previously it was 15-19%, now it's 14%. It's kind of okay. I look at debt to equity ratio, removing goodwill because I don't think it's a productive asset, and I also net out current liabilities and current assets and remove both from assets and liability side, and goodwill I remove from equity. So just my own ratio that I kind of developed for tangible assets and debt to equity this way. They are leveraged. They're more leveraged than they used to be many years ago. So again, I held it for more than a decade, so I kind of have this history of their reporting. This may or may not reflect their current financial reporting. If you go back, they will probably restate things because they've divestitures, acquisitions, the past historical statements do get restated quite a bit. So lots of debt, barely making any money, but then for a pipeline, just like for real estate, the income statement is not as important as the statement of cash flow. So looking at their cash flows, I see that operating income is kind of robust. It definitely is enough to pay the dividend, but in order to maintain and grow that dividend, they have to spend money on capital expenditures and acquisitions. And I'm sorry to say that, but their capital expenditures are bigger than the operating cash flows, let alone the dividends. So this company is promising to deliver 3 to 5% growth in dividends. However, to deliver that any kind of growth, they have to invest. And the only way to invest is to spend more money. And to spend money that they don't have, they gotta either borrow or they gotta print their shares. So what they're doing is they're empire building. Just like Enbridge, they borrow, they also print, and they issue their shares. That's just basically issuing as much as they need to, diluting us, existing shareholders, in the process, building a bigger empire, acquiring more pipelines, but the average shareholder, sort of the average guy, is a little bit better off. We are better off by 3%, 3.4% year over year. Previously, it was kind of the same. See, like in the 12, like decade ago, the dividend was also growing by 4 or 5%. So they're making small incremental progress in terms of adding a little bit of cash into our pocket, just slowly growing that amount, not even keeping up with inflation. In the meanwhile, they have to issue more shares and issue more debt. That's empire building. If they don't issue shares, if they only finance themselves from their own cash flows and kind of build out equity that way and borrow only as needed, they would not be able to grow as fast, but maybe they would have been able to grow better on a per share basis. Who knows? I'm not an expert on pipelines. They have a management team that needs to think long and hard about it. But it does look to me that this empire building is simply increasing the size of the company, not so much benefiting the individual shareholder like myself. This is very much close to what Enbridge is doing, but Enbridge, unlike TC Pipeline, is delivering more operating cash flow compared to their capex and dividends. They're short by $1 billion-ish, maybe a few billion, but TC Energy is short by way more, so they're not as efficient. Their capital expenditure program is bigger compared to their cash flows, and yet their growth in dividends is pretty much the same. They're also promising that this is coming from, the growth is coming from partially funds from operations, which is fair, but then also from issuance of debt and from asset sales. But if you're building those assets and selling them, or if you're buying them and then selling them, that's probably not increasing your cash flows. This is decreasing your cash flows. It frees up capital to do more investments, which will potentially be sold in the future again. So, I mean, it's a bit of a cycle of empire building, buying, selling, increasing the size of the company, but not so much benefiting individual shareholders. And the company's stock is sort of reflecting that. As I said, it's been kind of stagnating compared to S&P. We really underperformed by the factor of 3. The dividends will help compensate for part of it. So let's say TC Energy on average was 5% dividend yield. S&P is probably 2% dividend yield. So the 3% differential per year over the 3% over the 10 years. So maybe 30% more was delivered in dividends. So let's say you would have been up here somewhere, 150, 160 compared to 300 by S&P 500. So definitely a lagger, conservative, cash flowing, depends on what you need, depends on what kind of portfolio of yours is holding it. Also certainly impacted by higher interest rates in the previous few years. I mean, it wasn't so bad prior to the financial crisis of COVID. I shouldn't be calling it financial crisis. It was a blip really on the long term, but still. Post-COVID, interest rates flatlined, and then it went so much higher that Enbridge and TC Energy just suffered from it. Meanwhile, the rest of S&P benefited, especially technology. So comparably, I'm sort of on the sidelines. It's a nice dividend. If interest rates go down, then dividend-paying companies like TC Energy and Enbridge will benefit from that as well. their dividend will be more appealing to investors because the overall level of interest rates in the economy is going to be lower, so the prices are going to rise and the dividend yield is going to be smaller then. So there is a potential for a price spike. I don't know how much of that will be truly reflected, and then technology companies will also benefit because the lower interest rates environment in the future years will also make those future earnings of technology companies look more appealing as well. So everybody's going to rise. Question is who's going to rise more. So as much as I like my dividend, I am sort of on the sidelines. Slow growth, lots of debt, interest rates falling is a question mark. Hopefully they fall. Everybody's expecting them to fall, but you don't know how much and when. In the meanwhile, we are potentially missing out on quite a bit of an opportunity. So should I sell? Should I buy? It's a small part of my portfolio. I'm still kind of on the sidelines. I'm still undecided. I'll give it some more thought, but curious to see if you are thinking about it the same way. If you have any comments or suggestions on how to think about pipelines in general. So Enbridge and TransCanada with TC Energy are the two. The other one is Enterprise Partners. I want to take a look at them as well. Leave me a comment, like this video, subscribe if you'd like, and talk to you soon.